let's have a chat about the debt market and what's going on. It's probably quite prevalent at the moment. I think, we've seen a lot of leverage in the markets over the years, probably not as much as we saw, pre-GFC, but the market's obviously changed quite a lot in the last few months. What are the things that have changed and what are we seeing at the moment?
So it's, as you say, there's been a lot of change, but it's definitely not what we were seeing during the GFC. And I think it's something that we're sort of trying to reassure clients is the difference is that there's still huge amounts of liquidity out there. It's just how lenders are really assessing debt and then the cost of debt, which is sort of driving some of the changes in the fundamentals. So the difference to the GFC was it was mainly a banking market at that time. Now we have got, on our database, at least we've got over 300 different lenders that you could go to. So, and there's new sources of capital being, raised constantly and new lenders that are coming into the markets. But the key difference is how lenders are assessing what is, where their debt appetite sits. And pricing, and as you've just mentioned, the changes that we've seen in terms of cost inflation for our clients, for our developer clients, and then coupled with sort of inflation around staffing, and then on top of that, interest rates rises and the underlying cost of capital increasing is having a knock-on impact into sort of not the availability of debt, but the quantum of debt that clients can raise. And we're seeing from clients' perspective, there's a dichotomy in terms of how whether you've got an investment asset, and so a lot of clients didn't hedge. So that is now having a knock-on effect where they either didn't hedge and then they were too late to hedge, and therefore they're now seeing that underlying cost of capital come through. It's just another impact on their overall sort of debt service that they can look at.
And it's a day one cost as well, I guess, hedging.
Yeah, exactly. And so that's why I think we saw a change in the market. Pre the GFC, everything was being hedged. Interest rates fell off and everybody felt that was very expensive. What we're now seeing is actually clients who did hedge at 1% are now thinking, well, actually, this is really good value. And I'm actually I spoke to a lender this morning and they're speaking to them to say, well, can I sell my hedge? Because actually there's value to be had there. Back in the money. But predominantly what that's meant is that there is this impact, sort of immediate impact and on clients as we see the cost increase in terms of the underlying cost of capital. Mm-hmm. So therefore, it's not that there's not liquidity there, it's just how clients go and access the market, and the structures, the funding structures that are put in place just need to be a little bit more creative.
We're probably seeing a lot more of a diversity of products in the market at the moment. What are the kind of options out there for our clients looking to refinance or finance their assets at the moment? So there's numerous options available for clients depending on what their strategy is. So whether their strategy and their own internal returns are linked to putting the maximum amount of debt into a structure or actually limiting the pricing. So, and depending on that will then depend on the types of funders that we would go to and the structure that we would put in place. So whether that be just senior debt, or whether that be senior plus mezz, or whether they're looking for a whole loan, which debt funds are available to do, or there's the sort of funders that are coming in that are looking at putting in mezz options as well. So there's a myriad of options available. It really does depend on what the client strategy is. And that's where we see that we can sort of really help our clients is by sort of linking the funding structures to their strategy rather than it being a one size fits all. Borrowing from debt funds different from borrowing from normal clearing banks, or is it, what are the kind of advantages and disadvantages of either, if any?
There's differences, yeah. And again, it depends on client requirements. So the banks will be restricted in terms of the quantum that they can put into any transaction, and therefore for the larger transactions you will be looking to potentially club a deal, so you need to bring together a number of different lenders, and there's complexities in doing that. They are currently becoming a little bit more cautious again, and they have their internal policies and their internal cost of capital that they have to look at. Conversely, with the debt funds and alternative lenders, they've raised their capital at a certain return. Therefore, they are are usually more expensive than the banks. However, with the underlying cost of capital at the moment changing, there are tipping points where actually the debt funds where they've got some fixed cost of capital can actually be similar pricing to the banks.
And you mentioned strategy being really important, and I guess when you're looking at operational real estate, where really we're kind of financing, less so financing real estate, but we're probably financing trading businesses essentially. I think being clear about that strategy is really important when you go to the market to make sure you kind of get the right product. And I sense, from my perspective, a pound isn't always a pound. It comes with different sort of, different types of conditions, different costs. And I suppose it's really important that our clients assess everything in the round, not just the costs, but actually how can the structure of the debt be accretive to what that particular property or business is trying to achieve, I guess. And so your expertise in understanding operational businesses is incredibly important. And do you think it definitely makes a difference when we go to the market and approach lenders?
Definitely, and I think the presenting the credit risk of the business is as important as presenting the assets, and therefore we need to be able to understand it, and we need to be able to understand the cash flows, what the key drivers of those cash flows are, how a business makes a pound, and what impacts there could be on that, and what levers they can pull, and then really presenting that to lenders along with the longer term strategy of the business in terms of what they're looking to do and how they're going to manage their costs or how they're going to drive revenue. And it's looking at it through a lender's lens rather than through an equity lens. So when you go and speak to raise equity, it's about seeing growth, and exponential growth is always seen as what equity providers want to see. Yeah. It's a bit generalised, but
but no, you don't want to.
You don't go in it if it's not going to grow.
Make a loss, do you?
Exactly. So. Whereas from a lender's perspective, they want to just make sure they get their money back. That's their key objective, and I think it's really understanding the difference between an equity investor and a debt provider and a lender, because their key I suppose concern is around sustainability and sustainability of profit. So it's not just about revenue, it's about the profitability of the business and then how that drives cash and how that cash can repay and service their debt. And that's something that we help clients in terms of how they explain that to lenders. Mm-hmm. We spend a lot of time really unpicking the business plans, kicking the tires, looking at the sustainability and challenging management as well around their own assumptions, so that when we present that to a lender, we can present a robust financing case. It's not just about price. It's, the best deal is not always the cheapest deal, because there are other factors that play, especially for operational businesses. And ultimately what you want to be able to do is put a debt structure in place that then allows you to go off and run your business, not run your business to meet your debt structure, if that makes sense.
And that's why I think understanding the business and the dynamics of it, is really important for us, but also for the lenders as well, because you exactly that. You don't want to be beholden to what they want, and it stops you from actually running your business. And I think in our sector, it's very much understanding things like seasonality, things like stabilisation, looking at how, if you're capexing a building, how are you measuring that return on investment, which isn't necessarily all straightforward and linear, and it's making sure that I guess we can advise on those nuances. Talk to me about mezz financing. we talk. I think there's a lot of myths potentially about mezzanine financing and bridging and all those, and actually they can be quite accretive in certain situations. What's the current sort of market look like, and what are the potential sort of options that people can start to explore in that space?
Yeah, there's mezz and bridging finance. It's not the evil sister to senior debt as such. It's it is very much accretive, and I think in this current marketplace there is going to become sort of more and more demand for it, and actually we're seeing more and more lenders looking to move into that space where sort of equity providers are feeling that they can actually make reasonable returns, but also from a client perspective, and more importantly from a client perspective, it helps them either in a refinancing situation plug a gap. So for example, we're seeing a lot of developments coming to PC now, development financing come to the end and they want to refinance, and actually being able to refinance utilising senior plus mezz financing on a blended cost of capital is going to be cheaper than leaving the current facilities in place to run. So there's definitely a place for it there to plug the gap. We're seeing more lenders come into this bridge financing space because we're sort of starting to see transactions taking longer, or where clients are looking to maybe utilise the time at the moment to work up planning or to change planning. It really does lend itself to helping in a position where not everything is certain. So when you go to raise senior financing, you need to have certainty on and tick every box. Whereas with bridge financing, they'll take a view. These are experienced people, they understand the market, and they're willing to take a view in certain areas. And again, it's not, especially with the underlying cost of capital increase at the moment, bridge financing in the round is not as expensive as it might be thought to be.
There's definitely a way to use bridging to your advantage. Yeah, and we've seen that especially in markets where there's limited transparency, and it's going to take a little bit more time to work that up. If you can secure favourable pricing on the asset, then the bridge financing is buying the value in that, I guess, is buying your time to control the asset, drive the narrative, and then go and get a more sort of favourable senior package around
Exactly.
it when you control the timeline.
Yeah, it gives you space, it gives you thinking time, but it enables you to move really, really quickly as well. And that's the key. As you say, in a dislocated market, you need to be able to move quickly to take advantages of certain situations.
So we talk about operational real estate, and there's many different sort of parts of it, and some more nascent than others. Are there any parts of the market that the debt providers see as being more safe than others, and where they're probably more educated and feel more at home in terms of their capabilities when it comes to lending?
One of the key aspects that lenders look at is the resilience of the cash flows and the resilience of the drivers of those cash flows. So actually, across the operational space, in markets where cash flow drivers are deemed to be strong, so therefore they're less impacted by inflation, for example, so where we've got overseas buyers or we've got overseas renters, overseas students, that is deemed to still continue to be a strong market. At the higher end of the market, so in terms of 5-star hotels in London, that is always deemed to be a resilient market. So it always comes back to the resiliences of the cash flow.
So I suppose across the operational real estate landscape, many of the different verticals are relatively underbuilt. And so, development activity is still pretty huge, and there's lots to be developed. How is the lending market looking at, development and development financing, at this current time?
There's definitely still appetite out there for development financing. Majority of lenders like to diversify their books, so they don't want everything into investment, they want to have development as well. And I think from a client's perspective, it's about being able to really help lenders understand how they're going to, put in place the procurement nowadays, because from a construction perspective, fixed price contracts, whilst they might still be there in name, lenders are understanding that isn't necessarily what the fixed price contract used to be, and therefore lenders are becoming more aware of sort of trying to understand what clients' procurement factors are, and sort of how they're running their procurement processes and the types of contractors they're using.
The operational real estate opportunities and landscape really isn't just kind of bordered within the UK. There's a hell of a lot of opportunity across Europe as well. How can our clients and the businesses that we work with start to approach those lending markets, and what are the kind of key differences and things that they need to be aware of when we're looking to kind of secure debt in different European markets?
So there's a lot of similarities. There's obviously a lot of differences around sort of how you structure your security and how the availability of security in certain locations. But predominantly, especially with the alternative lenders, they look, it's the same teams that are funding in the UK that are funding across Europe as well. So there is a lot of similarity in terms of how they're going to assess a transaction, and that's where we can really help clients, though, in terms of helping the lender that might not have lent in a certain jurisdiction get comfortable with that jurisdiction. It's about them really understanding, well, what are the nuances from, you know, more of a UK transaction to what they're seeing in Europe. Obviously, the cost of capital is lower in Europe, and therefore we've seen a lot of the funds raising euro denominated funds, and they want to actively go and deploy across Europe. The types of assets that they'll look to lend into depends on the fund's own internal risk appetite, and whether they're looking to do investment or development across Europe will be very much, you know, fund by fund specific, but that's where we can help the clients in terms of accessing the right type of capital for them.